Hallo und herzlich willkommen zu unserer dritten Reihe des Private Equity Webinars. Heute werden wir über die Performance Measurement und Profit Distributions im Private Equity Markt reden. Bevor wir zum Thema kommen, würde ich ganz kurz mal das Team vorstellen wollen und ein paar organisatorische Sachen klären. Als Moderatoren ist heute die Katrina und der Max bei mir. Der Simon ist bei euch im Chat und beantwortet euch eure Fragen bzw. leitet sie an mich weiter. Und ich selber werde der Speaker für heute sein. Zu meinem persönlichen Background: Ich habe, bevor ich jetzt bei BCG im Private Equity and Principals Investors Bereich angefangen habe, als Hiwi an der TUM gearbeitet gehabt am Lehrstuhl für Entrepreneurial Finance, war zuvor bei Oaklands im Investment Banking im M&A Geschehen tätig und hatte auch Erfahrung im Venture Capital und Private Equity Bereich bei der SAS. Ich habe meinen Bachelor in Tübingen absolviert in International Economics und habe jetzt seit Oktober meinen Master in Management and Technology an der TUM begonnen. Und ja, bevor ich jetzt mit dem Webinar anfangen würde, noch organisatorisch, habt ihr jetzt bis nächste Woche Mittwoch Zeit, euch auf den Test, der dann als Vertiefungsmodul angerechnet werden kann, vorzubereiten. Nächste Woche Mittwoch findet dann der Test statt und ihr könnt dann dort quasi eure Punkte ergattern. Genau. Ihr könnt immer Fragen stellen. Ich werde probieren, nach jedem Kapitel auf die Fragen einzugehen, wenn sie nicht schon im Chat zuvor beantwortet werden. Das wäre es soweit von der organisatorischen Seite und jetzt würde ich fortfahren mit unserer Structure. Okay, so thank you for attending our third private equity webinar. Today we will talk about the fee components, performance measurement and distribution in private equity, and also we will have a look on observed historical performance of private equity funds. So this is going to be the last part. Feel free to ask questions whenever you want. We will try to answer the questions after every chapter. So let's begin with the fee components. When coming to the fee components, three major or three parts of fee components are the management fee, the portfolio company fee, and some extra fee and costs which arise. Out of these three fees, only the management fee is the most important one, since it is the only one who has a significant proportion on the overall transaction volume. The management fee is a fixed compensation for the general partner, which consists of a predefined fee which they get on committed or invested capital. Typically, this investment fee is about 2% for all private equity funds. This is something which is accepted within the whole industry, and therefore you won't see too many differences within the management fee. You will, if you look for the conditions of private equity funds, in general find a management fee of about 2% per annum on invested capital. So this is also an amount which can be really high. I mean, if you have 100 million invested capital, for example, this means for you that you get 2 million only for the management of the capital without any performance related compensation. When you look for the portfolio company fees, this is something which is quite often not really looked in the detail to it. This is something which arises partly once and sometimes over a longer period of time. Some incremental fees arise when a transaction happens. If a private equity fund acquires a portfolio company, then typically there is also a defined percentage of the overall transaction volume incorporated as a portfolio company fee, and also for the tracking and monitoring of portfolio companies by the general partners. There are some fees that are mainly related to EBITDA, So there are fees ranging between 1 and 5% EBITDA per year of a portfolio company, which is for the consulting which the private equity fund also offers his portfolio company, and all the help with the private equity company assists his portfolio company with. If we look to the extra fees and costs, these are costs that normally do not arise, but they can arise regarding to the type of transaction or some penalties. For example, when LPs commit capital, when they say, okay, I'm going to commit capital of 100 million and the capital call is mostly like 1 or 2 years later, let's say it's 2 years later, and the private equity funds wants to call 50 million, but the LP only can give him 30 million, then the LP is gonna pay a penalty fee for not providing the capital he has committed. So this is something which can arise when the LP, when the limited partner doesn't have the liquidity to meet the capital call. Another fee or cost are investment bankers or underwriting costs which arise through investment bankers. I mean, these are also costs that can arise and which are also covered, but as I said, out of these three fee components, only the management fee is substantial, since the portfolio company fee and the extra fees and costs don't make a big percentage out of the overall costs. And the costs are usually predefined in the private placement memorandum, which is like the marketing dossier which the limited partner gets from the private equity fund, where fund terms, structure, strategy, everything is written inside, and it is then finally determined in the limited partnership agreement, which is the final legal document for the private equity investment. So these are some important fees. Another more important fee component is the carried interest. I mean, we already talked about the management fee. It's 2% per annum, and it can be on invested or committed capital, depending on which stage of investment time the private equity fund is. In the beginning, mostly the management fee is calculated on the basis of committed capital, since in the beginning you did not do too many investments, so it would be a little bit confusing if you would calculate the management fee on invested capital, when you can expect that in the first year you will only have invested about 10% of your whole funds into a company. Then you would also only get 2% out of 10%, so this wouldn't be too much. Therefore, in the beginning, mostly the management fee is calculated on the basis of committed capital, but later it is calculated on the basis of invested capital, since you do not only want to pay management fee when you only want to pay the management fee when you are invested and not only when you are committed. Another big part is the carried interest. This is the part which is the most lucrative one for the general partners themselves, since through the carried interest, which is also called carry sometimes, they can participate on a performance related compensation after realizing a specific return, which is defined by the hurdle rate. The hurdle rate is the percentage of return a private equity fund has to deliver before he can participate in the carried interest. So you have, we will come to an example in the next slide, but here you have to think, after reaching the hurdle rate, the private equity company participates on a 20/80 basis, so they get 20% out of every penny which is generated above the hurdle rate. And sometimes after reaching the hurdle rate, there are different catch-up structures. So you have a hard and a soft hurdle rate. If you have a hard hurdle rate, you directly start with a participation of 20% after reaching the hurdle rate. If you have a soft hurdle rate, there is a catch up. That means that during this catch up, the LP doesn't get any money from the proceeds which are above the hurdle rate until the general partner has achieved 20% overall drawbacks. And this whole concept is typically referred as the 228 fee structure, with 2 regarding to the 2% management fee, 20% carried interest, and 8% hurdle rate. So if we come to our next slide, we can see how a typical return distribution could take place. The LP starts with an initial investment, let's say 100 million initial investment. And when and how does the LP get the money back? Well, everything starts with the LP getting his drawdowns back, like everything that has been taken from him for the investment, also management fee. So first of all, he gets everything back he has invested in. Afterwards, he receives an add-on on what he has invested, the so-called hurdle rate. Let's say he starts with 100 million. First he gets his 100 million back, then he gets, let's say, 50 million hurdle rate. So after reaching 150 million, the hurdle rate is reached, and the general partner is also participating in the profits that are generated now. And depending on whether it is a hard or soft hurdle rate, there will be a direct catch up, or there will be no catch up at all, so that only a participation of 2080 remains. And yeah, that's pretty much it. And in the end, after reaching the hurdle rate, the following proceeds are equally distributed according to the 2080 distribution. So if you have a look on a diagram, maybe it becomes a little bit more clear how the performance distribution happens. We can see in the beginning that the LP is getting his preferred return, which is why there is a constantly increasing bar. Since if the fund IR increases, then the LP gets more from his initial investment, and he gets to the end of his hurdle zone. After reaching the hurdle rate, the LP doesn't get anything anymore until the agreed split carry is achieved. And so let's say we have an initial investment of 100 million, we have a hurdle rate at 150 million, and after being at 150 million, the general partner firstly will get about 40 million until he has reached the 20%, and after the 20% has been reached, so that the LP has got 150 million and and the general partner has become 30 million, which is when a 2080 split is realized. The rest of the proceeds which arise are evenly distributed according to the 2080 carried interest split, as you can see in the diagram. So afterwards, you have a full carried interest zone. The LP is again also part of the profit distributions after ending the catch-up zone. So if we have a look, we saw the catch-up zone, we saw the management fees, and now it could be interesting how net and gross proceeds actually differ. I mean, if we're talking about gross money multiples or gross internal rate of returns, we are talking about the returns which have been realized. We are talking about the returns that have been realized before the fees and the costs are have been deducted. And if we are talking about the net internal rate of return or money multiple, we are talking about what is left for the limited partner after fees have been compensated. So if we have a look on gross average money multiple, which means a money multiple is basically how many times the initial investment did you get paid out. If I invest 100 million and I get 300 million back on a gross basis, then I have a gross money multiple of 3 because I got my money back times 3. That's the money multiple. It's a really commonly used, a really widely used metric. If we have a look on the gross money multiple and the net money multiple, we can find a spread of 0.6% approximately, which is about 25% of the gross money multiple of the gross fund returns. So you have to be aware that when you are investing into private equity, a big proportion, I mean not the biggest, but apparently on average a quarter of the fund of the overall fund performance is used to pay the fund fees, which you can also see from the internal rate of return statistic. I mean, it is pretty much the same. You can see a gross internal rate of return of 35%, a net internal rate of return of 25%, which leads to an internal rate of return spread of 10%, which is apparently really much, and a return that everybody would also like to realize. Yeah. So we can see that there is a big proportion, a big difference between net and gross returns, but let's have a look how gross and net returns actually evolve according to on what they depend. We can see here on the x-axis the gross internal rate of returns of private equity companies, and on the left we can see portfolios which realize less than 8%. On the right side we can see portfolios which reach more than 50% internal rate of return. And we can see that the higher the gross internal rate of return is, the higher the mean spread becomes between gross and net. So that means on average the spread is increasing with the gross ERR, which means that the more your fund actually, the better your fund actually performs, the higher the percentual share is, which is the difference between gross and net internal rate of return. So we can also see from this graphic that higher spreads indicate higher fees within top funds. If you have a gross internal rate of return of more than 25%, you can say you are one of the top quartile performers, and so therefore we can see that the top funds, they charge higher fees, but not necessarily because the fees like management fee or carried interest is higher, but also because of unused dry powder. Unused dry powder is the committed capital which is not invested. I mean, you can think of it like this: if a fund has committed capital of 500 million, they won't invest everything because they would need to find investments that perfectly sum up to 500. So what they typically do is they realize they only spend about 70 to 80% of their committed capital, so that they at the end of the day have an unused capital or uncalled capital of 20 to 30%. Since you are paying a management fee on those 20 to 30%, you are actually paying for never called but committed capital. And the higher the proportion of uncalled capital is, the higher the related fund freeze, the higher the spread between gross and net internal rates of return. Yeah. So this was it, the fees. As far as I can see, I didn't get any questions yet. I would just wait for Simon whether he will come up with a question, but if not, we can come back to the questions from the first part later on. So we talked about the different fees, but also something really important is how do we measure performance actually. I mean, so far we talked about the internal rate of return and the money multiple as measures, but when we have a look on the typical private equity investment case, maybe we will find some reasons why the internal rate of return or the money multiple is not the best metric to look on. We can see in the beginning, within the first couple of years here, that we have capital calls and we have drawdowns but no distributions within the first 2 years. After the first 2 years, there are some distributions, and the black line symbolizes the accumulated cash flows. We can see that in year 5 approximately we are breaking even. So after year 5 we got our money back and we are actually realizing profit on our initial investment. And how those distributions and drawdowns can be calculated as a performance metric can be firstly made with some typical measures such as total value to paid in and internal rate of return. The total value to paid in is nothing more than having a look on how much did I invest in the beginning and what did I get back at the end, like what I said, the money multiple. And the good thing is money multiples can be calculated really fast. If you see you get back 3 times the cash that you invest and you already got your metric, it's 3.0. But it also has some big drawbacks. One drawback is apparently it doesn't account for the money's time value. It doesn't account for different time periods. I mean, if I know the money multiple is 3, that means I could have tripled my investment, but I don't know within which time period. So it can be that this investment has tripled within 5 years. It can be that this investment has tripled within 50 years. But with only looking on the money multiple or the total value to paid in, I can't assess in how many years this money multiple has been generated, and therefore the money multiple often is not enough in order to evaluate an investment, since it doesn't correct for the time value of money and also doesn't correct for different time horizons. The internal rate of return is something that most of you, or I would say all of you, already know. It is it is a metric that can be also, it's not hard to calculate it. This time you maybe need Excel, can't do it in your head, but it considers the time value of money, and it also gives you the opportunity to compare 2 investments with irregular timings and also irregular cash flows. So the internal rate of return, it corrects for different time periods, and therefore if I realize a multiple of 3 within 50 years, it will be accounted for in the internal rate of return calculation. One drawback of the internal rate of return is that it is not directly comparable to public markets, so it has no benchmark inside, and you can also not really effectively assess mutually exclusive projects with the internal rate of return. And sometimes there are cases where you can't calculate internal rate of returns at all if you have investments which have two turning points. For example, you have capital calls in the beginning, you have capital calls in the middle, for example, and you have 2 times 0 point, then you cannot calculate internal rate of return, which is also a big drawback, especially in private equity, where also capital calls can arise after the 3rd or 4th year, which can lead to several 0 points within the overall cash flow calculation. So, having had a look on the traditional performance measures, and we'll also have a look on a more sophisticated measure, which I personally like pretty much, since it also accounts for many factors which are not directly obvious for. So what those measures are generally called public market equivalents, and the public market equivalent which I'm going to introduce you to is the Kaplan-Schwab public market equivalent, which is known as the most reliable public market equivalent. There are also some others which have the same motivation but different implementations, and therefore also different quantitative drawbacks, which is why the Kaplan-Schwab and PME is, from academic point of perspective, the most used one. What the Kaplan-Schwab private market equivalent does is it benchmarks the returns that are generated through our private equity investments to our equivalent public market investment. So if you invest 100 million into a private equity fund, and let's say 50 million of your committed capital has been called for an investment in the beginning, then what the Kaplan-Schwab metric does is it goes long into the benchmark. Let's say it is the S&P 500, so it goes 50 million long in the S&P 500, and as soon as your private equity funds distribute some money, gives you some money back, you are going short with this money with the S&P 500. So let's say year 1 we invested 50 million into the portfolio company. This means that we are investing 50 million in the S&P 500, and as soon as we get proceeds from our private equity investment, let's say in year 3 we get 20 million back as proceeds, then you go 20 million in year 3 short an S&P 500. And after the fund is closed, you have a look on, okay, what's my public market equivalent performance? So what is the net cash flow of my longs and shorts into the S&P 500? And you take this as a benchmark to your normal internal rate of return, and then you correct for it. I mean, the advantages are it takes the time value of money into account, which is also something the internal rate of return does. But what is the real advantage is it compares returns directly to a benchmark. It has to be the S&P 500, it can be anything else, but the intuition and the idea to have a relative benchmark is really important, especially when macroeconomic trends are have significant impacts. For example, also during these times which we are in right now. I can give you a good example in this way. If you think of a private equity fund which has realized returns of 5% per annum, you would say, well, 5% internal rate of return, this sounds like a really bad private equity fund, since Hassan told me that on average private equity funds make about 25% internal rate of return. So maybe you would say, okay, I'm not gonna go with this investment. But what if I would say you that these 5% are generated within the time period in 2007 to 2009, like within the financial crisis? Then you would say, okay, 5% during a market down is really good, and of course much better than what you expect in the first place. And that's what the CAP launcher or public market equivalent accounts for. If the overall market goes down, your internal rate of return or your public market equivalent increases. So therefore you can also compare investments within 2007, 2008 with investments which have occurred during 2015, for example, even though the macroeconomic trends were totally different. That's only because you are accounting for the public market and therefore you are correcting for the macroeconomic trends. So this was it in general on the measurement methods. If you have further questions on that, you can please feel free to ask questions in the chat. The most important thing about those traditional and public market equivalent metrics is just to understand the motivation why you need a public market equivalent and why an internal rate of return is not enough. So then we'll come to our last chapter, to the observed performance of private equity funds over time. We can have a look first of all on private equity versus public equity and have a look on different fund strategies or investment strategies and how well they perform. We can see a statistic from Preqin, which is really interesting in this point to have a look on, which starts in 2000 with an index value of 100, and it looks how different fund strategies would have evolved if you would have invested the same amount into every strategy. What we can see first of all is that buyout funds seem to be the best choice in terms of fund strategies, since it outperforms every other strategy and it outperforms also the S&P 500 significantly. If we have a look on the S&P 500, we can see an index return of about 220 after the 15th year, and we can see an index return of more than 420 for buyout funds, which is almost double of the returns which have been realized through the S&P 500. We can also see that in between S&P 500 and the buyout strategies, we can find the all private equity strategy, which seems to be the second best one, where not only buyout strategies are included but also expansion strategies and funding series. And we can see that fund of funds are apparently not performing that much better than the S&P 500, and for specific time periods is also underperforming than the S&P 500. So we had in our first webinar, we talked about that funds of funds have less volatility, but as you can see, this decreased volatility also leads to a decreased return profile. So therefore we can see that fund of funds investments on average realize much less return than buyout funds do. What is especially interesting are the venture capital graphic, which we can see as the green line here. And we can see that with investing in the venture capital, you wouldn't have gained anything approximately. Most of the time you would have realized losses if you would cash out, but at the end of the day, with venture capital, no profit could have been realized, which is a really interesting finding. that venture capital on average is not a profitable business. The reasons why venture capital is not performing on average too good are really different, and is also not a topic that we want to cover in this webinar, but we should keep in mind that venture capital is also something where the competition has risen really strongly. We have much more investors, but the investors on one hand side, they are driving the prices higher, which leads to less returns since you buy it more expensive. On the other hand side, venture capital is more risky than private equity per definition. So therefore also a really good investment team is necessary in order to perform good in this market. I mean, you can see venture capital funds with internal rate of returns of more than 70% on the market. You can easily find this on private equity, since in venture capital you can realize those returns maybe a little bit, those returns are a little bit more likely, not easier, but more likely. But also this likelihood comes with a lot of experience, with a lot of knowledge in order to unlock those internal rate of returns. So if we have a look on the performance of buyout funds in particular, we can see that buyout funds are on general realizing positive returns. So every bar which is above 1 is a positive investment if you don't correct it for the hurdle rate. So we can see that in all cases we are realizing profits even within the financial crisis. On average nobody really lost money with private equity, but we can see that on average overall a trend, the internal rate of returns are slowing down. We have lower internal rate of returns than in the late 90s, but still we have really stable returns and also positive returns in the private equity sector. And on average you can keep in mind that with private equity an internal rate of return of about 25% is generated, which means a typical multiple of 2.5, a money multiple of 2.5. Like on average those investments take about 7 to 8 years. So within 7 to 8 years fund life, you realize a 2.5 money multiple, which is not a bad investment at all in 2012. So having had a look on the performance, we should maybe also compare private equity and venture capital, since this is something which is done pretty frequently, but we also have to, while comparing those two investment types, we have to note that there are big differences, therefore not all numbers are directly comparable. So first of all, we can see that the overall performance of venture capital funds are higher than buyout funds, which could indicate that venture capital funds did better than buyout funds did within the last within the time period between the 2000s and 1980s. But apparently this is not necessarily true, since if you don't have an average, which is just the average of the three numbers, which you can see the three numbers between 2000 and 1980s, one should have had a look on weighted average, like the money that is invested and the return that is generated. If we would have a look from this point of perspective, I'm sure that buyout funds would have a better overall performance than venture capital funds. We can also see that venture capital funds are always underperformed than public equity. Only in 1990s they had a really big they had really high returns during the 1990s. On average, you could realize through venture capital investments 2 times the return that you could have realized through the S&P 500, which is quite a lot. Like you're 2 times realizing 2 times more return than the benchmark. But we can also see that this only happened once in our time periods, and within the other 2 time periods, within the 2000s and 1980s, the venture capital investments underperformed, which means an investment into the benchmark would have been more profitable than an investment into venture capital funds. And this trend is also the case for the most recent time period in the 2000s. There we can see with a public market equivalent of 0.9 that on average, as the benchmark performed 10% better than the venture capital investment. But we can also see that buyout funds consistently outperformed the S&P 500, which is especially interesting for large institutional investors, since they are looking for less volatile markets and also for markets where they can invest enough money inside. I mean, into venture capital, we are talking about ticket sizes between 100,000 up to 2 million, and within private equity, we are talking about investment tickets from 5 million to up to, let's say, 5 billion or even 50 billion. So therefore, the big difference within the investment volume is a really important factor also for the investors when choosing the right investment strategy, because it's not only important which asset class gives you the best returns, it's also important whether this investment strategy is feasible. And if there is no feasible due to the volume that you want to invest in, then there's also no investment opportunity for you. Okay, this would be from the private market equivalent perspective, which is quite interesting because we can see that buyout funds are on average performing better than the S&P 500, and venture capital funds they can have really high returns, but on average also they are characterized by lower performance than the benchmark. So when we have a look on the internal rate of returns, which are related to the public market equivalents, we can see that during the 90s, we can see that venture capital funds were outperforming buyout funds really strongly. I mean, having an average internal rate of return of more than 44% against buyout returns of about 12% is a really big difference, which is why after the 90s a lot of money was invested into venture capital. But afterwards we saw a backslash in venture capital. On average, venture capital returns of more than 1.5% losses against buyout returns of more than 10%. So overall, we can say that there was a sharp decline in venture capital returns in history, but this is like the same what I said one slide ago, that the private equity funds have more stable returns, overall returns, than the venture capital investments. They can have really high returns, but on average, the high volatility also leads to reduced overall performance. So maybe one last thing to have a look on is how persistent is fund performance, because limited partners, investors often get the feeling that the biggest and the shiniest names are the best ones. So being invested into a Blackstone private equity fund is something that limited partners would maybe like to do instead of investing into some new name private equity partners. But how reliable is this strategy to always go with the fund managers which had the best performance in the past? We can see with the green, you can see at the green mark that in North America, if a fund was rated within the top quartile, which means they have realized more than 30% internal rate of return, it is in 40% of all cases this fund manager is gonna be in the top performing funds within his next fund. If we look in Europe, we can see that only 20% of all top performing fund managers are gonna be a top performing fund manager also in the future. So this means that the phenomenon that top performance is something persistent is something that happens more in North America and less likely in Europe. But what we can see for both geographies is that the flop rate is the lowest for fund managers which have been in the top quartile in their previous funds. So that means we can see it here with a 14 and 15% likelihood that if a fund manager was within the top performing funds this year, then the probability that he will be in the flop funds next year is only about 15%, which also indicates that maybe the likelihood for a top performing fund to be again a top performing fund is not too high, but the likelihood that a top performing fund becomes a flop performing fund is quite low, which is also an argument which can lead to an investment into a top performing fund. So this would it be for this today from the webinar. I will have a look on the questions you have posted, you have asked me. Okay, that's the first question I see. I will read it out in German. Warum ist Venture Capital dann aktuell so im Trend? Die meisten Business Angels können doch bestimmt auch in PE investieren. Okay, die Frage ist auf Deutsch, deswegen will ich jetzt einfach mal auch auf Deutsch antworten. Ja, Venture Capital ist sehr im Trend, aber ich würde sagen, Private Equity ist mindestens genauso im Trend. Also die gleichen Investmentzuwächse, die prozentual gesehen natürlich, die Venture Capital erfährt, tut eigentlich Private Equity auch erfahren. Warum Venture Capital besonders auch für Business Angels interessant ist, ist eben der Grund, weil Business Angels auch mit relativ wenig Investment auch ziemlich kontrollierende Anteile haben möchten. Also dabei geht es dann nicht nur darum, dass am Ende des Tages der Business Angel einen Return daraus zieht, sondern dass er sich auch strategisch stark mit einbringt, was halt bei Ventures deutlich einfacher ist, weil da auch noch die Unternehmen überschaubarer sind. Für einen Business Angel ist es einfacher, ein kleines Venture zu betreuen, nebenbei und dabei auch noch ein bisschen was zu investieren, während Arbeiten, die er sonst so macht, als ein Unternehmen zu betreuen, was in der Größe eines Private Equity Investments ist. Deshalb ist Venture Capital für Business Angels auf jeden Fall viel interessanter, weil sie mit relativ wenig Kapitalinvestment relativ sehr kontrollierende Stakes bekommen können. Ich hoffe, das hat die Frage ein bisschen beantwortet, sonst kannst du auch gerne einen Nachtrag dazu schicken. Dann sehe ich noch hier eine weitere Frage. Meinung zu Aurelius. Also ich würde erstmal vorab prinzipiell jetzt keine Fragen zu einzelnen Private Equity Häusern beantworten wollen, aber Aurelius ist sicherlich wie auch wie auch durch den öffentlichen Medienbericht einer der Top-Performing Funds in Deutschland und tut auch entsprechend sehr starke Renditen erzielen. Von dem her gäbe es da jetzt, glaube ich, auf jeden Fall keine negative Meinung, die man da äußern könnte. Aber wie gesagt, ich würde das Ganze objektiv gerne belassen und dann nicht unbedingt auf einzelne Feedbacks zu Fundmanagern zurückkommen, weil ich da ja auch nicht die riesige Erfahrung habe. Es ist jetzt nicht so, dass ich mit Aurelius da riesige Kooperationen oder so etwas mal gehabt hatte. Okay, ansonsten, ich schaue mal hier durch, ob es sonst noch eine Frage gibt. Ansonsten gibt es keine Fragen mehr. Ja, also das wäre es dann auch soweit von der ganzen Webinarreihe. Ich hoffe, es hat euch Spaß gemacht. Ich hoffe, ihr konntet was lernen. Wir sind uns, beziehungsweise ich bin mir auch bewusst, dass meistens manche Folien vielleicht etwas abstrakter waren, dass auch die Erzählungen vielleicht jetzt auch sehr stark abstrahiert waren von dem, was auf den Folien stand. Das ist auch alles dem geschuldet, dass die Investmentmöglichkeiten, die Strategien in diesem Bereich eben eine gewisse Komplexität an sich haben und deshalb auch die Herangehensweisen nicht immer so trivial sind. Ich hoffe, ihr konntet trotzdem einiges dazulernen. Ich werde auch die Fragen gemeinsam mit Simon dann erstellen für den Test. Die werden jetzt nicht darauf abzielen, dass jetzt jeder von euch jede Folie auswendig gelernt haben muss, aber die werden auf jeden Fall darauf abzielen, dass ihr die Intuition der wichtigsten Sachen verstanden habt. Also so zusammenfassend vielleicht als Tipp sowas wie, warum brauche ich ein Public Market Equivalent oder was ist der Unterschied zwischen einem Opened und Closed Fund. Das sind so Sachen, die eher hoffentlich vom Verständnis her noch drinnen im Kopf geblieben sind. Ansonsten kann man da einfach nochmal drüber gucken. Ihr könnt mir auch gerne eine E-Mail schreiben, damit ich euch einzelne Sachen nochmal einfach auf euch zurückkomme. Gerne auch auf LinkedIn oder wie ihr mich da erreichen möchtet. Ansonsten habt halt im Kopf, dass ihr jetzt eine Woche Zeit habt, bis zum nächsten Mittwoch, um darauf zu lernen. Es gibt kein Handout soweit, weil das wurde auch ganz am Anfang gesagt gehabt, das hätte ich vielleicht heute nochmal erwähnen sollen. Die Fragen werden jetzt nicht besonders schwierig sein. Also ihr braucht da jetzt nicht zu erwarten, dass man da richtig viel drauf pauken muss. Aber es wird auch sicher nicht so sein, dass man mit Leichtigkeit alle Fragen beantwortet. Ich würde vielleicht einfach empfehlen, nochmal zu gucken, was ist Private Equity, wenn man das jetzt noch nicht ganz verstanden hat, vielleicht ein kleines YouTube-Videochen dazu oder auf Investopedia, das ist meistens schon komplett ausreichend. Und dann noch ein paar Investmentformen. Welche Investmentformen gibt es? Wenn man solche Kleinigkeiten schon drauf hat, dann sollte man ziemlich gut durchkommen, würde ich sagen. Also da auf jeden Fall nicht zu viel Stress machen. Ich hoffe, das ist auch in Ordnung, dass es diesmal kein Handout gibt. Genau. Das wäre es aber ansonsten soweit von mir. Wenn es sonst eurerseits auch keine Fragen gibt, würde ich den Stream hiermit beenden. MC-Fragen. Einen Moment, hier kommt noch eine Frage. Ja, die Klausur ist Multiple Choice, aber nicht eben wirklich Multiple Choice, sondern also es gibt quasi nur eine richtige Antwort von mehreren Antwortmöglichkeiten. Also es gibt nicht mehrere richtige Antworten, es gibt nur eine richtige Antwort, aber mehrere falsche dann quasi. Single Choice. So. Genau. Ja. Ähm, okay. Wenn es sonst keine Fragen mehr gibt, dann, ich sehe, das war's, ja, und das war's jetzt wohl anscheinend endgültig. Nochmal vielen Dank meinerseits für das Webinar, für die Webinarreihe, hat mir Spaß gemacht. Ich hoffe, ihr konntet was lernen und ich freue mich auf zahlreiche Prüfungsversuche.